So you want to know more about the Greeks, right? Yeah, but not the Greek philosophers such as Plato and Socrates, although they are still very cool with their teachings. But they're not gonna make you money, right? You try to open a trading account, but you saw all those strange Greek symbols, and you panicked because you never studied ancient literature. And now you're desperate for a teacher that will help you understand in the way for these magic letters, the Greeks, and make money with options. Well, you're in the right place, buddy. We'll have a deeper conversation around the Greeks that are used to trade options, how do they work, and what are the various factors that affect them. So you will be able to buy and sell options, understanding the risks and avoiding potential disasters. Hi guys, I'm Giuseppe and I'm a finance graduate and money nerd. And today, following the video on options trading, we're talking a little bit more about the Greeks, as I promised, and how they influence the price of call and put options. Please remember that this video is just educational and does not contain any financial advice. So without further ado, let's get started. Delta. Delta is the first derivative of the price of the underlying stock to the option price. In simpler words, delta measures the change in the option price for every change of $1 of the underlying stock. Delta can be included between 0 and 1 for call options, since they make money when the stock price increases, and between 0 and -1 for put options, since they make money when the stock price decreases. Let's make an example. Let's say that I have a long call option on AMD with a strike price of 150, and the current price of AMD is 150 actually, so the option is at the money. When an option is at the money, the absolute value of its delta is going to be 0.5. At the money means that the stock price is going to be exactly at the strike price. This means that if the price of AMD moves from 150 to 151, so it increases by $1, the price of the underlying option will also increase by $50, because we're gonna compute 0.5 times 100, because every option always works for 100 shares. So we have an increase of $1 multiplied by 0.5 that gives us a result of 0.5. If we instead have a long put option on AMD and this move from 150 to 151, we're gonna lose $50, because put options have negative delta instead, so they decrease in value when the stock prices increase. We will have +1 multiplied by -0.5 equal -0.5. Delta increases for call options as they get more into the money and is gonna tend toward 1 when they are deep in the money, while an out of the money call option will have a delta that is below 0.5 and will tend to 0 as the option goes more deep out of the money. On the other hand, a deep in the money put will have a delta that is gonna be near -1, and a deep out of the money put is gonna have a delta that is gonna be near 0. The higher the absolute value of the delta, the higher the price of the option is gonna be. This also happens because delta is also considered a proxy of the probability of the option to end up in the money. For example, it is approximated that an option with 0.7 delta is gonna have a 70% probability of ending up in the money. So far we're talking about the value of delta if we go long, but what if we go short? In this case, we just multiply by -1 our initial computations. So let's say that we go short on a call option that has a delta of 0.5 on AMD, and the stock goes up by $1. In this case, we have that we lose $50, because we have to multiply 0.5 times 1 times -1. That gives us -0.5. On the opposite side, short put instead have positive deltas, and in that case we're gonna do -1 multiplied by 1 multiplied by -0.5. That gives us a positive 0.5. So we have that long calls and short puts will have a positive delta, while short calls and long puts will have a negative delta instead. A final note on delta is that it tends to flutter on the linear value of the stock as the expiration gets closer. Gamma. Gamma is the second derivative of the price of the underlying stock over the price of the option, or also the first derivative of delta. In simpler words, gamma measures how much delta changes for a movement in the underlying stock of $1. Gamma is positive for both long put and long call options. Let's say that we have long call options and put options, both at the money, with a gamma of 0.08. So initially our deltas are gonna be 0.5 and -0.5, respectively for the call and for the put. So let's recall the example of AMD with a stock price of 150, and the strike price of the options are both at 150 as well. If the price of AMD increases by $1, the call option is gonna have more delta, because it's gonna go in the money. Plus $1 multiplied by 0.08 gamma plus 0.5 delta, that gives us a final delta of 0.58. On the other hand, if AMD moves from $150 to $149, we'll have minus $1 multiplied by 0.08 gamma plus 0.5, that is the initial delta of the call option. And this gives us a final delta of 0.42. We can do a specular reasoning for put options. So in this case, we'll have that if the price of AMD moves from 150 to 151, we'll have plus $1 multiplied by 0.08 gamma minus 0.5 delta, that is the initial delta of the put option. And this is gonna give us minus 0.42 delta. That is gonna be the new delta of the option. Similarly, if we have that the price of AMD moves from 150 to 149, we'll compute minus $1 multiplied by 0.08, that is the gamma, minus 0.5, that is the initial delta. So the final delta is going to be minus 0.58. Note that the absolute value of the delta of every option that is in the money is going to be between 0.5 and 1. Instead, the absolute value of every option that is out of the money is going to be between 0 and 0.5. Another thing to say about gamma is that gamma is maximum at the money. Since at the money, any swing in price can determine if the option is going to be out of the money or in the money, and so determine if the option is going to be worthless or not. Moreover, gamma increases the closer you get to expiration. Since nearby expiration, the option price is going to be more nervous, and any small swing can determine if the option is going to end up in the money or out of the money, without so much time to recover. The entire computation of gamma becomes negative instead if we sell options, and in this case we create a gamma negative position. That is not a great place to be, but we'll talk about this in another video. Vega. Vega is the first derivative of the implied volatility over the option price, meaning that it measures the change in the option price for a movement of 1% in the implied volatility. Vega is positive in both call and put options if we go long. Now, why Vega is important? Simply put, whenever you buy an option, you are paying a fixed amount of money for a potential unlimited upside, because in the worst case scenario, the option expires worthless, and you just lost the value of the option. But in the best case scenario, the price of the underlying stock can go up to infinity, or down to zero in the case of put options. So if the option expires worthless, you cannot lose more money than the money that you spent to buy the option. But if it goes in the money, it can potentially print a lot. Think about the call option holders of GameStop in 2021. For this skewed situation, options can make more money when there is more volatility. Vega is higher the farthest you are from expiration, since more time to expiration will mean that any change in volatility will have more time to exploit its effects. And Vega decreases as you get closer to expiration. Also, Vega is maximum at the money, because it is the point in which there is more extrinsic value. That said, Vega is gonna be negative if we sell options, since now we're gonna be on the side that is gonna have a fixed premium, but an unlimited potential loss. Theta. Finally, we have Theta. Theta represents the daily decrease in the extrinsic value of the option, meaning that the extrinsic value of the option will decrease by an amount of theta for every day that passes till expiration. When we go long, theta is negative for both put and call options, since they bleed value every day that passes. Theta is higher at the money, since it is the point in which there is more extrinsic value. And also theta increases exponentially as you get closer to expiration. Because let's imagine an option that still has 100 days left. In that case, the passing of one day is gonna affect just 1% of its total lifespan. Instead, for an option that has only 5 days left, one day passing is gonna mean burning 20% of its lifespan. This relationship is not linear when it comes to theta, but this is just an example to explain the concept. So time is against us if we buy options, but is on our side if we sell options, since theta is going to be positive. And you can speculate on the passage of time, but again, selling option is going to be a matter for another video. So guys, thank you for watching. I hope you liked the video and you found it useful. So please leave a like and subscribe. And if you missed my initial video on how options work, you can find it here. Bye!